So if you're looking at a standard stock screener right now, Rhythm Capital probably looks like a really sleepy, maybe slightly risky mortgage company that's just barely covering its dividend.
Right, yeah. It just looks like a standard yield trap to most people.
Exactly. I mean, you see the ticker, RITM, you see this massive 9% yield, and your brain instantly goes to danger. But beneath that really boring red and green x-ray on your brokerage app is a $100 billion financial empire.
Which is just staggering when you really dig into it.
It is, and they are aggressively buying up like distressed San Francisco skyscrapers right at the bottom of the market just to lease them out to AI companies. So welcome to this special edition of the Deep Dive.
Glad to be here. There's a lot to unpack today.
There really is. And, you know, our Talk Ticker's mission is usually to keep these breakdowns strictly under 5 minutes for you, no fluff. But we're doing a special extended edition today because this transformation is happening right under the market's nose, and we need the time to really break down their Q4 2025 earnings call.
Yeah, you absolutely have to throw out what you thought you knew about mortgage companies to understand what they're doing right now.
Right. We're going data forward, opinionated, and actionable. We'll translate the Wall Street jargon so you know exactly what this means if you're holding or even considering this stock. So let's just jump right into the headline numbers because honestly, they require some serious translation.
They really do. The disconnect between what the screeners say and what the business is actually doing is, well, it's vast.
I'm looking at their GAAP net income for the full year, right? And it came in at $1.04 per share. But their annual dividend is a flat $1.
Right, which looks terrifying on paper.
Exactly. That is a razor-thin margin. I mean, if I'm an income investor, I see a 4-cent buffer and I'm instantly sweating. But then management comes out on the call and points to their earnings available for distribution, their EAD, which was $2.35 per share for the year.
Up 12% year over year, by the way.
Right. And they generated $419 million in EAD in the fourth quarter alone. So how can management claim they have this fortress balance sheet when the GAAP numbers look, well, incredibly tight?
So this is like the ultimate diagnostic illusion in modern accounting. I mean, the noise that's pulling down that GAAP number is entirely driven by a non-cash mark-to-market adjustment on their mortgage servicing rights in the fourth quarter.
Okay, wait, let's pause there. Mortgage servicing rights, or MSRs, basically the fee they collect for processing mortgage payments, right?
Exactly. And because GAAP accounting is so rigidly standardized, Rhythm has to constantly, revalue those MSRs on their balance sheet based on a snapshot of real-time economic assumptions right at the end of the quarter.
But an MSR is fundamentally an interest rate sensitive asset, right? Like when rates stay elevated, prepayment speeds slow down because nobody in their right mind is refinancing a 3% mortgage into a 7% mortgage.
Right, nobody is doing that.
So the life of that servicing fee actually extends, and the asset should become more valuable. So if rates have generally been high, why did they take a conservative write-down in Q4? Like, what actually spooked their models?
It was two very specific, localized factors that management had to bake in. First, you just have seasonal increases in delinquencies and advances.
Like people spending too much at Christmas and missing a payment.
Yeah, exactly. The winter holidays routinely see this slight temporary uptick in 30 to 60-day late payments. But the second thing, and this was significantly more impactful, was a new FHA modification rule rolling through the Ginnie Mae system.
Oh, okay. Let's drill into that FHA rule impact, because this seems to be where the paper math totally divorces from the actual cash they're bringing in.
Precisely. So this modification rule is designed to help struggling homeowners restructure their debt for long-term stability, which is great, right? But mechanically, as those modifications are being processed through the administrative system, it forces the loans into a technical delinquency status on paper.
Ah, I see. So it looks like a default when it's really just paperwork processing.
Exactly. It creates this artificial temporary spike in 60-day and 90-day delinquency metrics. And Rhythm's accounting department, they have to look at that raw delinquency data, feed it into their valuation models, and legally write down the present value of the MSR portfolio.
Wow. So they take a hit on their official net income. They are forced to record a massive paper loss on the value of the asset because of an administrative backlog at the FHA.
Yeah, exactly. Even though the actual cash they're generating from servicing the broader portfolio is still just pouring in at record levels, the cash flow literally never stopped.
Which explains the EAD number.
Right. That's why the EAD, which strips out these non-cash mark-to-market accounting swings, remained incredibly robust. I mean, $419 million or 74 cents a share just for the quarter.
So they easily covered the dividend.
Oh, easily. They covered their 25-cent quarterly dividend by nearly 3 times over in real, actual cash generation. And Michael Nierenberg, the CEO, he specifically highlighted that this mark-to-market adjustment is highly likely to reverse in the first quarter of 2026 anyway, as those modifications just clear the system.
So for you listening, it's literally just a temporary accounting blip masking what is actually a ridiculously strong quarter. And you see that strength when you look at their return on equity.
Oh, the ROE is fantastic.
Yeah, an ROE of 24% for the fourth quarter based on that EAD number. I mean, generating a 24% return on equity in a complex, shifting interest rate environment where originations are pretty much suppressed across the whole industry. That's not just luck. That takes some severe operational discipline.
Yeah, it demonstrates that their hedging strategies are operating flawlessly. They noted on the call that they are fully hedged against their MSR portfolio.
Yeah.
But to your point, you don't hit a 24% ROE just by playing defense, you know?
Right, you have to be on the offense too.
Exactly. You hit it by fundamentally changing the composition of your earnings.
Which brings us perfectly to the most critical part of this transcript, which is the transformation. Because if you just look at the $1.7 billion in cash and liquidity they're sitting on, the obvious question for an investor is like, what on earth do you do with that kind of capital?
Right, especially when the standard mortgage game is currently a brutal race to the bottom.
Exactly. You don't just sit on $1.7 billion.
No, you deploy it to buy high-margin, scalable businesses. And that is exactly what they've done. I mean, Rhythm crossed a massive psychological and financial threshold this quarter. They now manage over $100 billion in investable assets.
That's a huge milestone.
Huge. They have $63 billion in their asset management business and $53 billion on their own balance sheet.
Okay, but I want to push back on this pivot for a second.
Okay.
Because they are, at their core, a mortgage company, right? I mean, their Newez arm funded $63 billion in volume in 2025. They are the third largest servicer in the country.
Managing a portfolio of 800,000 loans, yeah.
Right. And it generated $1.1 billion in pre-tax income. So if that foundational engine is running that well, why take the risk of aggressively buying up credit funds and real estate operating companies? Why pivot away from what you are clearly the best at?
Well, because the long-term terminal value of a pure-play mortgage company is capped. The multiples the market assigns to a mortgage servicer are chronically low.
Because it's cyclical.
Exactly. The cash flow is phenomenal, but it's highly cyclical and it's capital intensive. Nierenberg recognizes that the new res engine is a massive cash generator, but it's a cash generator that needs to fund a higher multiple business model.
Ah, okay. So that's why they acquired Sculptor, and that's why they just closed the acquisition of Crestline in December.
Precisely.
Let's break down those acquisitions then. Because bringing in $20 billion in AUM from Crestline completely changes their capabilities in the credit markets. How does an insurance and direct lending shop like Crestline actually mesh with what Rhythm is already doing?
Well, it provides them with an entirely new arsenal of capital solutions. I mean, Crestline brings a 20-year track record in direct lending, opportunistic capital, net asset value lending, and a really massive insurance footprint.
So it's not just residential mortgages anymore.
Not at all. And when you combine that with Sculptor, which, by the way, brought in $5.8 billion in gross inflows this year and has a highly successful $9 billion multi-strategy fund Rhythm, suddenly controls north of $40 billion in dedicated credit strategies.
That's incredible scale.
It is. They're no longer just originating loans. They are managing the capital that buys those loans. And they're collecting management and performance fees on every single dollar they deploy.
Wow. Okay, so they are building a full ecosystem here. They have the mortgage side pumping out raw cash. They have Sculptor executing complex real estate and multi-strat plays. And they have Crestline doing direct corporate lending.
Yep, all feeding each other.
But the puzzle piece that really jumped off the transcript for me, and arguably like the boldest capital allocation move they've made, is the Paramount real estate acquisition.
Oh, the Paramount transaction is the absolute definition of opportunistic capital deployment. I mean, Rhythm acquired a portfolio of 13 large Class A office buildings located in New York and San Francisco.
We're talking about roughly 13 million square feet of commercial real estate in two of the most heavily scrutinized gateway cities in the post-COVID world.
Right, the cities everyone else said were dead.
Exactly. And the pricing they got is insane. They acquired this portfolio at an average basis of $585 per square foot. Management noted that is a 40% discount to pre-COVID valuations.
And more importantly, a staggering 75% discount to actual replacement cost.
Right, meaning if you wanted to physically build those exact same skyscrapers today from scratch, it would cost you 4 times as much as Rhythm just paid to buy them outright.
That is the margin of safety that makes this place so compelling. I mean, other commercial real estate operators are currently being crushed by legacy debt that they took on at top of market valuations, right?
Yeah, they're drowning in interest expense.
Exactly. But Rhythm stepped in with a clean balance sheet, unburdened by that legacy CRE debt, and just bought the absolute best properties at the exact bottom of the cycle.
I understand the discount, I really do, but buying San Francisco commercial real estate right now just feels like catching a falling knife. Like if you look at the raw numbers provided on the call by Peter Brinley, their San Francisco core portfolio's occupancy rate is sitting at a dismal 62.2%.
Which is low, yeah.
It actually dropped year over year because of known move-outs at One Market Plaza and One Front Street. So how is a 62% occupied building a good investment, even at a 75% discount?
Because occupancy is a lagging indicator. You always have to look at the leading indicator, which is leasing velocity.
Okay, tell me about the velocity.
Well, while current occupancy is optically low, their actual leasing activity in San Francisco is up 330% year over year. Yeah. Over the last 18 months, their total leasing activity has surged by 615%. They completed 16 major deals totaling over 400,000 square feet. And the critical metric here is the lease term. It's an average of 8.6 years.
Ah, so these are not just short-term pop-up leases or co-working spaces.
No, these are massive, decade-long corporate commitments.
And the driver behind that surge is obviously the AI boom, right? The narrative that tech companies only want remote work is being completely shattered by artificial intelligence startups.
Completely shattered. The transcript explicitly noted that AI companies accounted for more than 20% of all leasing activity in San Francisco.
That's huge. I think it totaled over 2 million square feet citywide. I mean, San Francisco venture capital funding hit $134 billion in 2025, and a massive chunk of that is going straight to hardware-intensive, highly collaborative AI companies.
Exactly. Nirenberg specifically mentioned Anthropic coming in and taking down entire buildings. I mean, building foundational AI models requires intense, in-person collaboration, highly secure on-premise hardware setups, and a physical footprint that remote work simply cannot replicate.
You can't build server clusters in your spare bedroom.
Right. And over half of this AI demand is coming from tenants that are entirely new to the market. San Francisco is cementing its position as the undisputed global capital of AI development, and Rhythm is sitting on the premier real estate to house them.
And because they bought at such a massive discount, they actually have the capital flexibility to aggressively upgrade these buildings, don't they?
They're pouring money into hospitality-driven amenities.
Because if you want a top-tier software engineer to come to the office 5 days a week to build AI, the office needs to feel like a high-end hotel, not a 1990s cubicle farm.
Exactly. They are capturing the flight to quality.
And we see that exact same flight to quality playing out even more maturely in their New York portfolio. I mean, the work-from-home debate is practically over in New York.
It really is. Their core New York portfolio is sitting at a 92.8% leased occupancy rate, which is up 780 basis points year over year.
Which is phenomenal for commercial real estate right now.
Yeah. They signed 43 deals in 2025, totaling 1.3 million square feet. And the average lease term was an astonishing 13.8 years.
Signing a 14-year lease in Midtown Manhattan is a massive statement of intent from corporate America. 5 of those deals were for spaces over 100,000 square feet.
Yeah.
And because high financing costs have essentially halted all new office construction, the supply of Class A space is actually shrinking. So demand goes up, supply is constrained, and rental rates inevitably rise.
It's a textbook supply-demand imbalance, and Rhythm is perfectly positioned to capitalize on it. But, this leads us to a really critical macro discussion that management spent significant time on during the call.
Right. Section 3 of our breakdown, management guidance. During the Q&A, Nirenberg explicitly brought up the Trump bump and the appointment of Kevin Walsh as the new Fed chair. Now, just to be crystal clear for you listening, we do not take political sides on this show.
No, absolutely not.
Our job is strictly to translate the market mechanics of what management is signaling. So how did they frame this politically charged macro environment?
Well, from a purely mechanical standpoint, management views these political and central banking shifts as catalysts for a steepening yield curve.
Okay, let's define the mechanics of that, because the yield curve has been entirely inverted and honestly pretty chaotic for the last few years.
Yeah, it's been a mess. So in a normalized economic environment, the yield curve slopes upward, right? A short-term instrument, like a one-month treasury bill, yields less than a 10-year treasury bond because investors demand a higher return, a term premium, to lock their money up for a decade.
Makes total sense. More time equals more risk, so you demand more yield.
Exactly. But to fight inflation, the Fed aggressively hiked short-term rates, pushing them higher than long-term rates, which created an inverted curve.
Which makes lending incredibly difficult, right? Because banks generally borrow at the short end and lend at the long end. If the short end is more expensive, the margin just compresses.
Exactly. A steepening yield curve means that spread is widening again. Short-term rates drop relative to long-term rates. And Rhythm's management stated unequivocally that their balance sheet is constructed to benefit from this exact scenario.
So they're perfectly positioned for it.
Yeah, they're positioned along the front end, holding assets tied to those shorter term rates, and they are not carrying significant short positions on the back end. So as that curve steepens, the mechanical spread they can earn across the various lending platforms expands organically without them having to take on any additional credit risk.
That's a great spot to be in. And the platform they are aggressively pushing in this macro environment is asset-based finance, or ABF. Nierenberg called ABF the single hottest product that LPs want today.
Oh, it absolutely is.
But I got to inject some skepticism here. Every single asset manager on Wall Street right now is trying to pivot into ABF. It is the buzzword of the year. Why should we believe Rhythm has any actual competitive edge in a market that is rapidly saturating?
Well, it really comes down to the difference between being an originator versus being a middleman.
Okay, unpack that for me.
So asset-based finance involves lending money against hard collateral, think real estate, airplanes, heavy equipment, pools of consumer loans, rather than lending against the general unsecured credit of a corporation.
Right.
Pension funds and sovereign wealth funds desperately want this because it offers low double-digit returns with the massive downside protection of tangible assets.
Right. But a lot of asset managers just raise a fund and then go buy those loans from someone else, basically just taking a spread.
Exactly. And that is where Rhythm has the structural advantage. Rhythm actually originates the assets themselves. Nierenberg pointed out their Genesis platform, which did nearly $5 billion in residential transitional loans just this year. Yeah. Because they originate the loans directly and then service them on their own platforms, they capture the entire economics of the life cycle. They aren't paying a premium to a third-party originator.
Ah, so this allows them to offer highly competitive yields to their limited partners while maintaining thicker margins for themselves.
You got it. They just launched a closed-end ABF fund with a $200 million initial seed from a major pension, and they are expanding separately managed accounts with overseas clients. I mean, they're feeding a starving market with vertical integration.
That vertical integration allows them to be incredibly disciplined on pricing, too, which was a huge theme of this call. An analyst brought up the fact that competitors in the wholesale mortgage channel are being irrational with their pricing.
Yeah, essentially they're taking losses just to buy market share and boost their origination volume.
Right. And Nierenberg refused to take the bait and calls competitors irrational, but his underlying message was honestly ruthless. He made it clear that Rhythm absolutely refuses to participate in a race to the bottom. They will not chase unprofitable volume just to satisfy a quarterly origination target.
And, the data backs up that discipline. Despite pulling back on unprofitable volume, their gain on sale margins actually improved quarter over quarter. Their originations in non-agency and non-qualified mortgages grew by over 200% year over year.
So they are capturing the high-margin, complex originations and letting their competitors bleed cash, fighting over the low-margin vanilla loans.
Exactly. And that discipline is only possible because they are rapidly driving down their internal cost to originate a loan through massive investments in artificial intelligence and technology.
Yeah. They announced 2 critical tech integrations on this call. First is Velon, which is a next-generation servicing operating system. Rhythm actually seeded Velon back in 2019, and they are now integrating it to manage their 4 million homeowners.
And Nierenberg hinted that their early equity stake in Velon could eventually be worth billions. which is a massive hidden asset not fully reflected in their current book value.
But the second integration is the one that directly impacts the bottom line today, right? Home Vision, their AI-powered underwriting decision engine.
Yes, this is huge. The historical bottleneck in mortgage origination has always been underwriting. It's a highly manual, human-intensive process of, verifying income, auditing tax returns, checking compliance.
Tons of paperwork.
Tons. But by integrating Home Vision's AI into their pipeline, Rhythm has already doubled their underwriting capacity without adding a single unit of headcount.
Wow. That is massive operational leverage. If you can double your output while keeping your fixed human capital costs flat, your cost to produce a loan just plummets.
Exactly. It allows Rhythm to remain highly profitable even if they hold the line on pricing while competitors are slashing rates.
Okay, so all of these operational victories, the AI underwriting, the ABF expansion, the real estate acquisitions, the fortress cash flow from the servicing portfolio, all of it is just prologue to the central thesis of the stock.
Yep. It all builds to the main event.
Right. It all leads to the corporate structure catalyst that management was heavily telegraphing on this call. Let's use an analogy here to explain exactly what is at stake with this corporate structure, because this is where the asymmetric upside lies for you, the retail investor.
Let's hear it.
Think of a real estate investment trust, a REIT, like a highly profitable toll booth on a major highway. By law, that toll booth is required to take 90% of the cash it collects every single day and hand it straight to the townspeople, the shareholders, in the form of a dividend. In exchange, the toll booth doesn't pay corporate taxes.
Right, which is a fantastic structure for generating current income. It's why yield-seeking investors love REITs so much.
Exactly. The townspeople love getting their daily cash. But the inherent flaw is that the toll booth can never accumulate enough retained capital to build a second highway or a bridge or an airport. It is mathematically constrained from massive compounding growth.
And more importantly, Wall Street looks at that toll booth and values it at a very low multiple, currently around 6x earnings for Rhythm.
Because the market prices it purely on the liquidation value of its current assets and its current yield.
Exactly. But traditional alternative asset managers, the Blackstones, the KKRs, the Apollos of the world, they are structured as C-Corp.
Right, regular corporations.
Yeah. They keep the tolls, they reinvest them to build 10-lane superhighways of asset management infrastructure. They generate fee-related earnings, taking a percentage of the massive pools of capital they manage for other people.
And because that fee revenue is incredibly sticky, highly scalable, and capital light, the market assigns a massive premium to it, right?
Huge premium. Asset managers trade at multiples of 15x, 20x, sometimes 30x their earnings.
And that is the exact transition Nierenberg is pointing toward. I mean, he literally stated on the call, at some point we do need to be a C-Corp. He explicitly called out that their current valuation is extremely low relative to what we do.
So management is basically telling investors, look, we are currently operating a massive, diversified asset manager, but we are trapped in the legal wrapper of a mortgage REIT, and the market is penalizing us for it.
That is the precise signal. As Rhythm continues to rapidly grow its fee-related earnings through Sculptor, Crestline, and their newly launched ABF funds, the justification for remaining a REIT just evaporates.
The roadmap here is incredibly clear, and it has been executed before. Blackstone itself used to operate under different structural wrappers before fully converting to a C-Corp. And when they made that conversion, it dramatically broadened their potential investor base.
Right, because massive index funds and certain mutual funds are legally or by their own mandates restricted from buying REITs. By converting to a C-Corp, you instantly unlock a tidal wave of passive institutional capital that is suddenly allowed to buy your stock.
Exactly. You get the mechanical buying pressure from index inclusion, and you get the psychological re-rating from the broader market. Wall Street analysts stop comparing Rhythm to legacy mortgage originators who are just struggling to survive a high-rate environment, and they start comparing Rhythm to elite alternative asset managers.
Which brings us perfectly to the bottom line, our final section. The actionable takeaway for you, the investor holding or looking at this stock. The signal from this transcript is decisively, aggressively bullish, driven by an incredible asymmetric risk-to-reward profile.
Let's quantify that asymmetry. The downside is heavily armored. You have a real-time estimated book value pushing $12.75 to $13 per share. The stock is chronically traded around or below that book value, which provides a deep margin of safety.
You're not paying a massive premium for future growth.
No, you are buying the assets at or below what they are fundamentally worth today. Furthermore, you have a 9.2% dividend yield that, as we detailed earlier, is safely covered more than 2 times over by real underlying cash generation.
So you are getting paid a massive 9% yield to simply wait for management to execute their strategy. And the upside strategy is not reliant on like a magical drop in interest rates or a sudden boom in the housing market.
No, the upside is entirely within management's control, multiple expansion via corporate restructuring.
Right. If they successfully execute this transition from a complex mortgage REIT into a C Corp alternative asset manager, the stock re-rates from a 6x multiple to a 15x multiple.
Exactly. Even if the underlying businesses, the mortgages, the real estate, the credit funds, just continue to perform exactly as they are right now, the stock price would theoretically soar simply because the market is assigning a higher premium to those exact same earnings streams.
It's just math.
Yeah. They have $8.5 billion of permanent capital. They generate over $1 billion in pre-tax income, and they have the strategic discipline to buy prime assets at cycle bottoms.
It is a company playing a completely different game than its legacy peers. They are basically building a mini Blackstone inside the shell of a mortgage servicer, a fortress balance sheet, a highly covered 9% yield, and a massive, clearly telegraphed catalyst for multiple expansion. That is the true narrative buried under the GAAP accounting noise.
It really is. But before we wrap up this analysis, there's one final lingering thread from that Paramount real estate acquisition that I think warrants serious thought.
Oh, let's hear it.
We've spent the last 4 years being bombarded by the narrative that remote work permanently destroyed commercial real estate in major cities.
Right, the dreaded doom loop scenario for downtown.
Precisely. But consider that 330% surge in San Francisco leasing, driven almost entirely by artificial intelligence startups. Could the intense, physical, hardware-heavy, highly collaborative infrastructure demands of the AI revolution secretly be the saving grace for major metropolitan office spaces? Yeah, it's an incredibly provocative counter-narrative. As AI companies transition from theoretical software models to massive scaled physical deployments, their demand for square footage is exploding.
Is AI going to physically rescue the very downtowns that the remote work revolution tried to abandon? It completely flips the commercial real estate thesis on its head. Keep a very close eye on the physical footprint of these AI unicorns as they keep scaling. That's a massive trend to watch. Well, thank you for joining us on this extended Talk Tickers deep dive into Rhythm Capital. We will catch you on the next one.